Hello, I'm Ryan Lightfoot Amanoff, and welcome to KTI's Ideas for Your ISA event. Now, just before we begin, we have a few bits of housekeeping. Please ensure that you have downloaded the WebEx app for the best experience, including for viewing the slides. If you are having difficulties with audio, please check your audio settings in the tab on the left-hand side of the screen. And finally, a recording of the presentation will be available on the website afterwards, as well as the slides, which will be available to download as PDF. Now, today we're joined by Richard Staveley of Rockwood Strategic to discuss his approach to investing in the smallest end of the UK equity market. Richard has overseen a period of exceptional performance, using the lack of research in the microcap space to identify overlooked opportunities, trading at attractive valuations, and taking strategic initiatives that can help unlock value. Whilst the broader sector has been under pressure for some time, Richard has navigated this admirably and will now spend the next half hour presenting his trust before handing back for about 15 minutes of Q&A. You're very welcome to ask questions as we go along in the box, and I will collate these questions and put them to Richard at the end. So without any further ado, Richard, please take it away.
Thank you very much, Ryan, and thank you everybody that's listening in today, and particular thanks to Kepler. I understand we're the last of this series, so hopefully we've left the best till last. So I can only conclude that most of you, because it's an ISA event, don't know much about Rockwood. Maybe some of you do, but I'm going to have to assume there's mixed understanding of what we're up to out there. I've gone for a shorter presentation than normal in terms of number of slides to allow more time for Q&A if it's required, but also to keep things kind of trimmed so that you can all get off to lunch. Rockwood, investment trust, of course, listed in London on the main market. Our NAV did hit 100 million 3 weeks ago. Donald Trump hasn't been particularly helpful in the last 3 weeks, so I think we're currently 98 million NAV. And we, as Ryan kindly said, are focused on the smallest end of the UK stock market. Make sure you read your disclaimers, and just to be absolutely clear, I'm not giving any stock specific advice to you guys today. The only thing I'm doing is presenting on Rockwood, which hopefully you will be interested in. Now, the summary slide's almost the most important because it concludes that we are a specialist fund. We're not like your normal UK small companies fund. These days, often most of those have much bigger businesses than what we invest in, and or the general public would call a small company, often £1 billion valuations to those businesses. So we're really quite differentiated both in style and approach, and that's as a result producing different returns than the average small cap fund in the sector. We think the strategy's proven now. I've been managing it for over 5 years, and we're in this incredibly inefficient market for UK smaller companies. In the last year, we've lost 2 of the other people that were looking in this space. So Downing closed down their microcap trust, strategic microcap trust, and Miton closed down their Miton microcap trust. And as a result, we really are one of the very few professional investors that spend all day long searching amongst this part of the market for the very best ideas. We don't have a index benchmark like normal fund managers. We're targeting 15% rates of return over rolling 3 to 5 year periods. So sort of perfect for time horizons that ISAs should have. And that really reflects what we're looking for in our underlying investments. So we look for stocks that can double at least over 5 years. We're not trying to do that too fast, but we know things take time. So we look for stocks, yes, and if they do over 5 years, I'm sure many of you will know the maths. That averages out at 15% a year. If it happens over 3, we get 25% a year, and some of them might go up a bit more than 100%. And those that take 3 years will offset those that take slightly longer, or those that don't meet our target returns. I'm a value investor. There's very few of us left, particularly in the UK. There's more of us in America. But I think that's relevant because quite a lot of people associate UK small cap investing with finding, the next newfangled drug or mine or technology. But we're looking for value and proven businesses. And we run a concentrated portfolio. There are currently 24 holdings in Rockwood, the majority of the capital being in the top 10 holdings. That'll drop down to 23 shortly because we had a bid recently for one of our holdings, National World, at a significant premium, and that will convert into cash in the next few weeks, and we'll redeploy that into this really quite depressed market and definitely a cheap stock market at the moment. Finally, we are active investors in the true sense of the word, so we take active risk. We don't care about what stock is in any kind of benchmark, but we also actively engage with the companies that we invest in. We do it in a constructive manner in nearly in all instances, and hopefully that constructive approach leads to a sort of mutually beneficial outcome for everybody involved. But we can roll up our sleeves and turn up the heat if we need to, if we feel that people are obstructing the realization or creation of shareholder value. I run the fund from Harwood Capital, which is a sort of hybrid family office set up by the legendary Christopher Mills, who has been investing for 40 years and over 40 years in the UK. Has a couple of investment trusts himself, but also a private equity team, a private capital team, private debt team, and property guys. And all of those give me additional insights you don't get necessarily in more mainstream type of environments or firms that are much bigger than us. And I find that very helpful for the area of the UK stock market that we focus on. And in talking about focus, I'm 100% focused on this fund. It's the only thing I do. Fund managers tend to get distracted by their organizations regularly, but it's the only fund I have, and I'm completely aligned. So my wife and I own just over 1% of the shares in Rockwood Strategic. We bought more recently at a higher price than they are today, I might add. I think I paid £2.65 rather than the current price. And we will be buying more with next year's ISA. At this point, I still don't really know how many of you have got sort of the clock ticking down. You may need to make a decision in the next few days, or you're sort of ahead of the curve and thinking about what you do for next year. I'm a kind of maximize my compounding kind of approach. So I'll be doing mine in April, and it will go into Rockwood. This slide is one that many small cap managers in the UK show, because it's very clear actually in that small cap investing in the UK does work for the long term. I'd make 2 points about this today. The first, this is the latest up to the end of last year, and on the chart on the left you see the different bars. And what it shows is this small cap effect running through the size bands. But what you'll find these days is that UK small cap managers are typically benchmarked or focused on beating what's called the Deutsche Numis Small Cap Index, which is the second bar on the right hand side of the chart, saying that it goes up about 9% a year over the long term. What's interesting is the next bar, the far bar, is the Deutsche Numis Small Cap 1000 Index, which is the smallest of the small, the bottom 2% of the market. And it shows that there is an additional performance premium for going further down. That is where we're focused, and it's not where the other small cap managers are primarily focused. And that clearly is one of the contributors to why we've have delivered better returns. The second thing I would say is that I think this long trend does suggest that UK small cap investing is a very good one for junior ISAs. For those with long-term time horizons, this is one for the kids, juniors, for SIPs and all that kind of jazz. I think they'd be well placed to have exposure to UK smaller companies over the next few years. The performance of Rockwood, as Ryan kindly said, has been strong over the last few years. And the key thing here is it's been a really tricky difficult environment for investing in the UK. As a result, our performance has meant we've beaten everybody actually. So we're very proud of that. But I think what's more important is a lot of people have got themselves into a real funk and tiz for many reasons about the state of the UK stock market, and I think and they sort of want to link that view of that stock market and of the UK and of their views on Britain to the likelihood of making money over the next few years in that market. And I think two things. The first is that I think we're demonstrating that you can generate strong returns anyway, and we think our approach will continue to bring strong returns even if things don't pick up more widely for the UK stock market. That said, there are a number of things which suggest that we may be getting to the end of this really quite tricky period for investing. I'll touch on those in a moment. Also, everyone seems to sort of at the first opportunity sort of dismiss our market as focused on boring companies, oil companies and banks and all that sort of stuff that populates a lot of the FTSE 100. But there are still really quite fantastic, globally leading, innovative businesses in the UK. And one that's been a key contributor to us in the last sort of 18 months is a company called Filtronic, which we think is gradually becoming a real star and will be much more widely known in the years ahead. And their technology, they're world leaders in radio frequency technology, which they use to make devices which are now being used by Elon Musk in his Starlink satellite network, currently having only won orders into the ground stations that transmit and amplify the signals up into space. And that is transforming the profitability of Filtronic. And literally, we've made 5 times our money on average by the end of last year in that stock. We actually started buying the stock at 12p a share. They're currently £1.11 today. And we think it's still got considerable further upside. I dwell on this not because I'm really pleased and it's done really well, but it's also really important for you if you're considering Rockwood. It's 10% of our portfolio, and so you get really good exposure to Filtronic through Rockwood. For those that know the business a bit better, its devices so far have only been ordered by SpaceX into the ground stations, but SpaceX are finding they need more ground stations than they originally thought. And Filtronic are working on products which would go into the actual satellites, and of course there are many more satellites than there are actual ground stations. And they also have yet to win contracts with other satellite networks who are trying to solve the same problems that Filtronic have solved for SpaceX, but those projects often are a bit behind Elon, who moves at serious pace. For those that are thinking it's done really well, I'm not just meaning that I've missed it. And you might think with Rockwood, but I would highly suggest that's not the case. But with the same with Filtronic, it was actually announced yesterday, which is quite convenient to speak to you all today about it. But yesterday, Elon Musk actually took another 5% exposure to Filtronic shares through warrants in order to support an expanded strategic relationship with Filtronic. I think it's the only share he owns in the UK, the public know about. So that's quite exciting to be involved with that. But to come back to why I've got the slide, the slide really is just to say there is still some really, really interesting businesses hiding in the bottom end of the UK stock market. It was 25 million quid market cap when we bought it. The UK, I don't try and claim I'm some sort of market and macro guru whatsoever. I really do. It's all about stock picking in Rockwood. But I think in a nicer decision-making process where there's all kinds of the other funds that if you've listened to the other seminars, you'll be considering. I think it is worth just touching on the UK. Patience has been required, but many people actually have sort of missed that to the end of February, the FTSE 100 was actually up just over 18%, and the S&P 500 was up just over 17%. That's the 12 months to the end of February. UK shares have actually been beating American shares in the last year, and that doesn't, that's not involving the currency, which has moved as well. Often in previous market cycles, the larger shares go first because they're the most liquid, and then the money starts to come in as people realize the market's on the turn, and you get a trickle down factor. But I think that is relevant. I think the second thing that's quite interesting is that we've become aware of market information that one of the big local authority schemes has actually sort of gone early in terms of reallocating money to UK small cap and getting ahead of whatever measures Rachel Reeves is going to force all of them to do, or push all of them to do. And that's significant potential amounts of money that could start to flow back into what's still quite an illiquid market. But for me, the most important thing is actually the interest rate cycle, and it's not really great news in that regard. Inflation feels as if it's not really coming down to a level that the Bank of England feel comfortable about taking our interest rates down at. But it's no doubt that the combination of Trump's I would say injection of uncertainty into particularly around trade, which is affecting multinational investment decisions and things like ad budgets and hiring and whether they sign off projects or not, on top of Rachel Reeves's budget, which obviously hit confidence, business, and to a certain extent consumer, but mainly to do with business about the national insurance contribution increases. It's not. It wouldn't be fanciful to say that the economic situation in the UK could deteriorate a bit further during this year, which would clearly open up the ability for the Bank of England to reduce rates further. For me, the current interest rate definitely does not feel like a neutral rate. It's clearly restrictive. So when those starts happening, what is the case is that when interest rates start falling, UK small cap tends to do really well. As I've said before, we're not relying on that, and an investment in Rockwood doesn't need to rely on that in our view. But if that did happen, that would make life easier for everyone for sure. So on to the approach of Rockwood, for those that don't know. So it's still a significant universe. Obviously, there's a range of mainly stockbrokers actually whining about how many stocks there are left on the market for them to charge fees to and list. But there are still hundreds of stocks to invest in. And as I've said before, we're a concentrated approach. So in any normal year, I'm looking for sort of 3 to 4 brilliant ideas. Hopefully, even 2 might do it in a fallow year in terms of moving the portfolio forward. But that's all we need to pick out of these probably 600, 700, 800 stocks. As I've said before, we're value orientated, but we're also recovery focused. So we're really looking for turnarounds, which that's the kind of style of investing that's within Rockwood. And we like that because these companies, it's self-help rather than relying on external environment or other factors that are driving returns in those businesses. Our focused approach allows us to do significantly more due diligence than one can do when one's running a portfolio of significantly more holdings. And we think that gives us an information advantage by being able to go deeper, wider and broader in terms of the level of research that we do on our stocks. It also, and as a result, we think it de-risks this approach. And we also feel that the engagement that we do, we get stuck into the companies, actually enhances the investment outcomes, not just for us, but for all shareholders. We buy proven businesses and business models. We focus very much on free cash flow generation and free cash flow generation potential in the businesses that we back. We believe in mean reversion, the reversion of profitability to prior levels, typically at a percentage. So we're big buyers of companies that used to make a particular profit margin, have stopped for whatever reason making as good returns, and we look to sort of analyze whether there's been some structural change, whether it's just ineffective execution, and that turnaround can occur. That typically requires some catalysts for change, which we need to identify, and we sometimes might be the catalyst ourselves for those changes. And in order to do that, we need to engage with all the stakeholders. Now, the stakeholders aren't just the usual, so the board and the man who are there on behalf of shareholders to make sure that the executives are the right executives, but we obviously engage with the executives as well. But also the wider will engage with the other shareholders as well of the businesses we invest in to try and see whether they're supportive of change and how they feel about their investment. And before we buy, we develop an exit thesis, which we can't necessarily rely on or indeed have a crystal ball about this sort of thing. But what we're cognizant of is it's an illiquid part of the market. We can't just rely on some other fund manager to buy the shares off us once we've made a decent return. We need to be clear that this is a business that other people would want to buy if it was put up for sale, whether those be trade buyers, strategic buyers, private equity. And so we think quite carefully about that before we enter the stock to see whether it's something that isn't going to become what I call a lobster pot at the end of the process. And what sits behind this philosophy is a view that companies go through this kind of life cycle, sometimes more than once, actually, for companies that are around a long time. But, what tends to happen is they make a strategic error. They've got hubristic. They've bought badly, often through M&A. But also it can be just complacency, tiredness, or a good business. Someone just retires and the person that replaces them just isn't on the ball, or the poor appointment, and you lead to this period of ineffectual operational execution. That then tends to lead to falling returns and falling profitability, which leads then to a depressed valuation because people don't like that. Shareholders in the market doesn't like that. It more often than not, but not always, results in financial stress of some form, either through a lack of cash generation or a stretched balance sheet. And it becomes highly emotional. So everyone's really wound up. The management team know that they're under a lot of pressure. The board are annoyed that they signed off on the M&A or haven't got rid of the finance director if they realise is incompetent. They haven't done anything about it yet. Shareholders are all upset. The advisors are embarrassed to be representing the company. And, you go down the pub. I've said this a few times over the years now, but you go down the pub and mention often a Rockwood stock after we bought it, and everyone sort of rolls their eyes and goes, that'll never turn around. It's awful situation. But we actually really embrace that negativity. It typically results in a very undervalued situation relative to a risk profile, which we then have to identify can be resolved. And that requires a new value creation and realization strategy. It almost always requires some form of enhancement or replacement of either the members of the board or the management team or both. The new team then need to work out their operational plan to turn around the business, establish what the target returns are going to be to recover shareholder value. And then that plan will either in itself stabilize the balance sheet, maybe a kind of divisional disposal or improve free cash flow generation, or indeed just a fundraising that we might cornerstone at Rockwood or encourage them to do to take the risk out of the balance sheet. And then once that's stabilized, the team hopefully will execute, gradually improve their returns as they sort out the business. Returns normalize. The stock market should work that out and re-rate the stock. And if they don't, then there's plenty of people watching the UK stock market at the moment, and we'll put in bids for these companies to take them off once they're stable. So we're on to stocks now. These are the top 10. I'll make a few broad comments first, and then I'm going to pick a few out completely by random. But just a couple of points first. We've got 62% in the top 10. Ideally, I'd like a bit more. We have had historically a bit more. It's just the way sort of some of the stock prices kind of moved around a bit, but ideally you have just a little bit more than 62% in the top 10. Those are the typical size weightings, maybe slightly higher. Initially, we buy about 2 to 4% of NAV in a stock, and then we then try and increase that to at least 5% for core holdings of NAV. You can see that there's quite a mix of sectors there. We don't have any particularly strong sector biases at the moment. And you can also see, maybe slightly surprisingly, that we've got a mix of main and AIM stocks. Most people assume we've got exclusively AIM stocks in Rockwood. It's definitely not the case. We can find lots of really interesting overlooked businesses hiding at the bottom of the main market. And I think probably the most important thing actually in terms of the headings is actually the CEO appointment date. It's a really important thing I'd like to land with all of you listening today, is that in our top 10, all of the CEOs have essentially been appointed basically in the last 2 and a bit years. That's really important because it takes time to turn around a business and create that minimum of 100% upside and the returning operational and improved performances of companies. And what I would say is that it's a bit of a generalization, but I think it's very important, is that quite a few of our holdings, the hard work and the risky phase of that 5-year phase has actually passed. That phase I call the stabilization phase, and it lasts normally between 6 and 18 months. Sometimes it does take a little bit longer, but typically between 6 to 18 months. And that's when the management are changing. We're sorting out the balance sheet. The new CFO arrives, and then it doesn't matter how much due diligence we've done at Rockwood. He's bound to find something that, as the new finance director, that no one's heard of, and it's always never good. It's always worse. So there's quite a lot of volatility around our stocks that we buy in the first phase after buying them. But in a number of our cases, businesses are really starting to move into delivery, and just to pick out, and that's where we would get good, strong re-ratings and performances of these businesses, and would drive NAV at Rockwood forward from where we are today. Examples of that might be, RM, Trifast, James Fisher & Sons, Restore, and those are all businesses where, if you take Trifast, for instance, which makes nuts and bolts, which sounds very unglamorous, but we don't worry about that sort of thing. It basically makes nuts and bolts and distributes nuts and bolts and fasteners, not exclusively metal ones. Obviously, they do other synthetic ones as well. Around the world, it has operations in the US, UK, Europe, and Asia. Has over 230 million of sales. And the new, since we've bought it, which has been in the last 2 years, that stock, we've now got a new chair, a new CEO, a new CFO, a new COO. We've got a strategy, a plan. The stock level, which was excessive when we purchased it at 100 million, has been got under control. I think at last counting, was down to about 75 million. And as a result, the debt position, which was elevated, is now fully under control. I think debt's about 15 million quid. Rockwood has, with the support of other shareholders, placed Nick Mills onto the board of Trifast. So we have a board position, and we've actually bought 15% of the company. However, Trifast has not been re-rated yet at all. We've got that decent stake in Rockwood in it. Its current market cap, which is roughly, it's actually slightly below what's on this chart here of 107. I think as of today, it's probably more about like 95 or something like that, 95 million. The company, Ian Percival, has gone in as CEO, proven turnaround guy. He's now making kind of underlying about sort of 6% operating margins, maybe 5.5 to 6% operating margins. He's just coming into that phase. And he's targeting 10% operating margins publicly to turn around. So significant profit growth on that £230 million sales base. that should come through from Trifast, which would create significant re-rating, and we think end up justifying a market cap well in excess of 200 million, giving us still 100% upside from that position. James Fisher and Sons actually had results this morning, believe it or not. You can look them up. And Jean Vernet, who's gone in there, who previously ran one of the big divisions at Smiths Group, he's gone in, and his first phase was again sorting out the balance sheet. This time it was through disposals, and they announced this morning that financial debt is down to about 60 million quid. So significantly lower than where it was following all the disposals. That's taken them off the risk point from a balance sheet perspective, and now he can focus on turning around profitability there. Now, just by some chance, it just so happens that he's also targeting at least 10% operating margins like Trifast. He's slightly ahead. I think he's at 6.5%. And the key driver for him will be the defence division. They've got three divisions: defence, marine, and energy. The marine's involved in shipping. The energy was historically involved in the, and still to an extent involved in the oil rig industry, servicing and maintaining the rigs out at sea. So it'll be involved in the decommissioning work that's going to happen in the next 30, 40 years in places like the North Sea. But it's taken that capability to the offshore wind market globally and does the same kind of maintenance and services into that. So that's what they call their energy division. The shipping business is a very niche but highly profitable division for them. And then the problem child's been the defence. Now, we all know what's happening with defence budgets, but actually they're in a very interesting niche in submarine rescue, and they've also developed some very exciting products for special forces. And again, the announcement this morning is right in line with our thesis. They've actually announced a material increase in the order book from the defence business, and we think that that is going to result in materially improved profit coming through James Fisher now over the next couple of years, which should drive our thesis. You can see the market cap there, 180. My target for their EBITDA, which is a proxy for profitability, is in itself 80 million pounds. And the multiple that James Fisher used to trade on prior to itself getting in its pickle and everyone falling out of love with it and hating it actually was 10 times EBITDA for a number of years. I think that's probably a bit excessive. So we're not that greedy about in our investment thesis, but I think if he turns around the EBITDA, I think it's reasonably likely that this re-rates to 8 times EBITDA. It's very solid, strong long-term business therein. I'm going to mention a couple more stocks. I probably should mention RM Group, our largest position, which is an educational services. They also had, it is results season, of course, but they also have had results recently, and a good solid set, and that is just coming into the delivery phase. Again, we have 15% of the equity. We, working with other shareholders, got a new non-executive director onto the board of RM to make sure we had someone that was involved in, had broken up a business before, which is what we hope and want to happen to RM. They've yet to announce any disposals, and we think that's imminent. And when that happens, that should reduce their debt materially, and then they can focus on their 2 remaining divisions, which we think will be their business distributing products to schools, of which many they design themselves, and as a result have decent margins. They supply 90% of the UK's primary schools, for instance. That business has about 80 million of sales, and we think should be making about a 9 to 10% operating profit margin. And then their second absolutely fantastic division, which we really like, which they call assessment, which marks exams, and it marks A-levels. It's big clients, people like International Baccalaureate and Cambridge Assessment, and the ICAEW that does the obviously the accountancy exams. It's a global leader, RM, in this space, and they're being used to help the whole digitalization of exams, which is underway now, and it's already a very profitable division. We think the value in it has been hidden by the problems that this group's had, and we think that as they focus up the group, the quality of that business, which we think is going to grow its profits materially over the next few years, even though it's already making kind of 18% margins, is likely to increase further, and it's still grossly undervalued. We think the business is worth about 170 million. You can see the market cap there. How am I doing for time, Brian? Are you listening still? I'm a bit not sure where we are. How long have I been going for?
34 minutes now, so we are a little over time. But
we should get straight on to. I've touched on that. We should get straight on to Q&A then. I do a couple of bit of housekeeping. Harwood itself, Christopher Mills personally owns 22% of the fund as well, so he is keeping his BDI on top of me and very aligned with shareholders. And we do have a performance fee. Singer Capital Markets are our brokers, and I think I'll leave it at that, Brian.
Brilliant, thank you. We have had quite a few questions come in, so please keep them coming. Use the box in the bottom right-hand corner. I'll broadly categorise them at the moment into some questions about the market more broadly. There's quite a few stock-specific ones as well. Where would you like to start, Richard?
Let's do the broader ones, just in case some of those stock-specific ones are people thinking about putting their stock in their ISA rather than Rockwood, which I don't mind, but let's do a few broader ones first, and then we'll get into the stocks.
Brilliant. Okay, I'll try and combine these two questions actually, because they are quite similar. So we've got one question about the changes in the budget back at the end of last year about the tax rules for AIM and how that affected the trust. And then also there's been a broader question as well about you engaging with your companies to move off AIM. So do you think the AIM market is broken? How have those tax rules affected your outlook on it? And how do you think this might evolve going forwards?
Yeah, that's a really, really good question. I can't be bullish about AIM. I think it needs help as a market. It is clearly incredibly unhelpful for the Chancellor to halve the tax breaks for investing in our junior market in the UK, number one. And there's some more nuance about how they've given the BPR relief, which is sort of making people consider those with AIM IHT portfolios, whether they go for BPR relief off market rather than AIM stocks. That is not helpful whatsoever. I think, secondly, though, I'm frustrated with the LSE isn't itself doing more actually for AIM. They seem quite focused on this Pisces new market, which feels a bit annoying when they really should be focused on making sure AIM is fit for purpose. And I think the third point I'd make, which is not helpful for AIM, is that the new reforms that have come through for the main market has reduced the amount of sort of, I would say, regulatory arbitrage that was attractive to some companies being on AIM rather than the main market. Mainly that you could do deals much more cheaper, the fees and the admin was much cheaper on AIM, and that's definitely less the case now. That said, I still think there is a role for having a successful junior market for more risk capital in a G7 economy that has loads of entrepreneurs and lots of interesting small businesses that want to scale and build. So I think that it may be struggling, but it doesn't feel like it's something that we shouldn't have. We just need to work out how to get more money into it. In terms of how it's affected Rockwood, I did mention earlier I do have some stocks on AIM, and it's interesting because some of those ones are ones where they don't really have any AIM funds sort of in. They're sort of quite quirky shareholder registers, and as a result, they haven't really been sort of subject to sort of drip selling from AIM related shareholders. But secondly, slightly more irritatingly, we get stocks like M&C Saatchi or Restore, both of which are outstanding AIM businesses, both valued at over 200 million market cap, that are held by AIM style funds, and as a result, we think are trading on literally ludicrous valuations. Where as a result, we are going to make lots of money from the business we talk. So if you take Restore, for instance, Restore is currently trading on a P of about 10. Now its historic valuation for the last sort of 15 years is a P of about 16, 17, and it was on 20 times for plus 20 times for a number of years. And why not? Because they're one of the market leaders in document storage in the UK, and that business makes 30% operating margins, and it basically converts dust into cash, essentially, as far as I can make out. That's the dust falling on the boxes that they just keep charging for until someone else asks for them back. And it's an unbelievable business model. And that business at 10 times is a no-brainer investment for us, particularly now that Charles Skinner's come back to sort of sort it out and improve the profitability further, which is what he's doing. If you take MC Saatchi, which again is owned by a number of important AIM investor institutions who may or may not be getting outflows, but I suspect they are dripping out stock. That has been derating despite a material improvement in profitability. It's quite a mature thesis for us, M&C Saatchi, had it for a few years now, where they've taken that from loss making and almost financial destruction and accounting scandal through to a net cash balance sheet and mid to high teens profit margins. And M&C Saatchi now is on a EV/EBITDA about 4 and a bit times, which is just insane given that they don't have any capex and they don't pay any interest. So the EBITDA is actually pretty much, so you're buying it on about just a few times cash flow for one of the world's greatest brand names in that space, but also a business that's pivoted and grown over the years into non-cyclical government communications advice services, which aren't ads, which aren't the reason why people might be a bit sort of sniffy about the macro environment and ads. So that will be the next thing. What happens next, I don't know. So just to conclude on this, we'd really like to see Rachel relook at this and do something about it. I mean, and for us, that would be a very, very simple. We've got one initiative. Half the problem with Rachel is everyone's giving her a different initiative, but we want everyone to get around one initiative, which is ISAs. In fact, what we want ISAs, and we want ISAs to be invested in the British stock market. We know some of the stocks aren't British businesses, and some of them are American funds listed in Britain. That's fine. We just want money to come into the British stock market rather into cash or into Nvidia shares. It's just not fair to give a tax break to buy Nvidia. And if Rachel did that, it would be tax neutral because the tax break's there already. And 800,000 people plus maxed their ISA last year. If all that money went in, continued, that's 16 billion a year into the UK stock market. By the next election, Rachel might be able to crow about compounded nearly 100 billion into UK equities that she's personally kind of stimulated. I mean, they won't even put the first spade into Heathrow by the next election. So anyway, I'm ever hopeful. If they do that and the local authorities start to invest back into UK small cap, which we believe they're going to start doing, that could really turn around AIM.
Very interesting, Richard. Thank you. You've actually had a couple of questions about the trust itself. Now, you are, as a result of the sort of strong performance, one of the few trusts trading at a premium, so you're able to issue stock at the moment. Firstly, where are the proceeds for that stock going? Are you increasing your portfolio? Is it going to existing holdings? And also, what would be the maximum capacity you think you can run this trust at?
Great questions and helpful for everyone, I hope. So the capacity is 250 million, although we'll be looking at it really, really carefully from about 200 million. As I mentioned earlier, we unashamedly have a performance fee for delivering performance, and all our performance is listed net of fees. It is totally not in my interests to have a too big a fund. So, which is the burden of many fund managers and many great fund managers. I mean, if you think about it, I'm pretty sure everyone will have their view on people like Neil Woodford, but in my opinion, he ended up with far too much money looking after, and that created things he did that was undermined him in the end. So we're looking to have in Rockwood no more than 250 million quid. So decent space to grow. The second thing is what we've been doing with recent receipts. Well, during Q1, we've bought one new share, which I'm afraid I can't lift the hat on yet because we're still buying it. But we found one real absolute cracker, which we've been buying. But actually, meaningfully for the last 3 to 4 months, we've been quite happy buying our existing portfolio and quite widely across them. There are 2 or 3 of the stocks that we're up to 29.9% of the company. So we can't actually buy any more. Otherwise, we have to launch a bid for the company. So we can't buy any more of them. And it's slightly irritating. They get mildly diluted as we keep growing because we're still very high conviction on them. But the rest has been going into buying more of the existing holdings. Right, I'm thinking there was a third piece in that question. Was there a third aspect?
It was about maximum capacity, and then also where the proceeds are. So
yeah. So it is across. At the same time, we haven't been, because we're getting inflows, we haven't got complacent about our positions either. So I can say that Funding Circle, which we still consider has decent upside and will remain an important position in the portfolio, had got up to over 14% of Rockwood, and we've more than tripled our money in the last 15 months in Funding Circle, having run an engagement campaign with the board there, the management, and work with other shareholders, which got them to buy back stock, do cost cutting, and recover a lot of shareholder value. So we've made a really good return out of that. We've taken that down from 14.4 to today it's 4.4. So we've also taken 10% of NAV out of one stock and reinvested that back into the portfolio. But one thing for sure is, we are patient, and the valuations on our holdings, we really are very excited about. So we've been adding across the portfolio.
Okay, we are running a bit short on time, so I might just do one more question. You talked about the 29.9% that you'll own up to. In some cases, you do invest alongside other Harwood funds. So what is the sort of overlap with some other vehicles in that stable, and what's like the interaction like with those other group funds and trusts?
Yeah. So there are 2 stocks we own that overlap with the Odyssean Investment Trust. They are Flowtech, Fluid Power, and James Fisher. And then there are a further 5 stocks which overlap with the other Harwood funds, Oryx International Growth, stroke North Atlantic small companies. That there's no rules about this, but that's probably about as many as I'd like, maybe one more at max, if I had to, in terms of meaning I just couldn't help myself to buy one of Christopher's best ideas or one of Stuart's Widdowson's. But essentially, I don't want that overlap to get too big, so that those that follow all the different vehicles get sort of confused about what they should buy and what they do. So, and that's some element of overlap. I would say it's a sort of a mutually beneficial overlapping Venn diagram where there's always going to be a little bit of over coverage. In terms of the interaction, it's great. We all work in the same building. Well, Christopher in the same, literally just a few meters away from me. Stuart's on the floor above. We actually have a Chinese ceiling between Odyssean and Rockwood. They're a separate LP than Harwood, but we obviously are all part of the Harwood wider family, and we'll talk about stocks. So it's a really great informal, I would say, ongoing discussion about markets, ideas, stocks. We don't have any formal meetings like that, and in almost all instances, it adds value to what I'm doing.
Well, thank you very much, Richard. Unfortunately, that does take us to the end of the time. So I do apologise for those
Feel
questions.
bad. I feel really bad that I've gone on and haven't been succinct enough for everybody. I do apologise. I haven't done that on purpose. I maybe fire in, if there's some way questions can get fired in, we'll do a kind of written response, and Ryan might just fire it out somehow to Kepler people. Maybe that's an idea of doing that, because I do want people to get answers to their questions.
Yeah, we'll try and take those offline just for those ones we didn't quite get to in time. But it just leaves me to say thank you very much, Richard, for your time. Thank you to everybody else for listening and watching, and for the questions as well. It's really good to have a very interactive session. If you would like to catch up on anything that Richard mentioned in the view, please, a recording will be available on the website before too long, including a copy of the slide decks, which you can download as PDF. For now, Richard and everyone, please enjoy the rest of your day, and we look forward to seeing you at the next event. Thank you very much.
Thank you, everybody, and just really appreciate it. Just don't give up on the UK at the very last moment when it's just starting to turn. Please don't. Take care, guys.